Hello and welcome to a new video for our course Finance 1. Today we're going to be talking about a very important concept that has to do with the relationship, the reasonable relationship that we should expect between risk and reward. Now, our roadmap will be the following. First, we will say something about what we expect this trade-off between risk and reward should be. Then we will get into what is it that it should be a proper measure of risk. We will simply pose the question. And then we will get to the right answer by making a very important distinction in finance, which is the actual distinction between firm-specific risk and market risk. Now, the intuition that probably you already have is that the higher the risk, the higher should be the reward. In the sense that if you're going to bear a lot of risk in your investments, it is because you're expecting a higher reward out of that. And this is nothing but a manifestation of a very important assumption in finance, which applies at least to most investors. They are risk averse. And therefore, if they're going to bear more risk, they will do it at the expense of a higher expected reward, of a higher reward. Now, it is for us very clear what it should be, this reward. This reward, it is expected return when we're dealing with uncertainty. Now, the problem is not here. The problem is what happens when we're talking about risk. What is it a proper measure of risk? Is it the variance or standard deviation? Let's see. Now, to illustrate this point, this picture contains all the insights that we need. And imagine that we're considering two types of investments. One of these one type considers investments, full investments in individual stocks. And another type considers investments in many stocks or bonds. As we know, we can observe past prices of these objects. We can go ahead then and compute the returns. And then with these values in our hands, we can go ahead and compute standard deviations and average returns in a way that by now we should be familiar with. Now, if we go ahead and we plot the result of this exercise, so we plot in the horizontal axis the standard deviations that we obtain, and in the vertical axis the average returns that we obtain. What we will observe is that our large portfolios, that is, our investments that consist in a whole bunch of financial assets, stocks or bonds, rather than full investments in one individual asset, will somehow line up. We can actually almost fit the perfect straight line through them. And our intuition that the higher the risk, the higher the reward, seems to be accommodated by the behavior of the returns of large portfolios. However, when we look at investments in individual stocks or bonds, what is going to happen is that they are not going to accommodate this intuition. For example, the return of an individual stock like that has a higher standard deviation than another return like that. And yet, the bottom return has a lower expected return than the top return indicated here. So we see that, and we can replicate this argument with many of the individual returns that we plot in there. So with not the individual stocks that we plot there, the return of the individual stocks that we have plotted there. And this implies that this initial intuition that we have, that the higher the risk, the higher the expected reward, is not accommodated by the returns of individual stocks. And hence, the standard deviation doesn't seem to be a proper measure of risk. Now, how can we make sense of this? How can we find then an argument, a proper measure of risk that somehow deals with these empirical patterns that we find in real data? So how can we make sense of this? In order to introduce an explanation to this empirical pattern that we have displayed here, we need to bring up the distinction between two types of risk. One is firm-specific risk, and the other one is market risk. Now, think about the possible variations in the price of a stock. Now, we can think of variations that are going to affect that single stock, single firm only. For example, a plant owned by the firm getting on fire. For example, the firm earning a very important contract. This type of variations are simply going to affect that specific firm and no other firm. Now, there are other type of variations that are actually going to affect every firm in the economy. This type of variations have to do, for example, with GDP growth, unemployment rate, announcements about inflation rate. This type of announcements are going to be something that are going to create variations that are going to affect every firm in the economy. Now, why is this an important point when we are thinking about risk? Well, if you think about what you do when you don't put all your eggs in a single basket, and you go ahead and you invest in more than one stock. You have a portfolio with stocks and bonds. Well, there's a part of those variations which have to do with this firm-specific risk. They're going to cause, they're going to create gains in certain stocks and losses in certain stocks. And since these gains and losses are unrelated, because they affect only individual firms and associated to the stocks that you have in your portfolio, or the bonds that you have in your portfolio, they will simply offset each other. So, to the extent that you insert more portfolios, more stocks or your bonds in your portfolio, the less will vary the wealth, your investment, the less variations will be in the return of your investment due to this firm-specific risk. Now, if you think now about variations due to market risk, variations that affect every single stock and the economy. Now, it doesn't matter whether you have one stock or many, because gains due to good news, for example, that could be in principle due to good news about the state of the economy, are going to create gains in every single stock in your portfolio. And the opposite, if there are reasons for which in the state of the economy that would drive down the prices of the stocks of your portfolio, the bonds of your portfolio, these are going to happen at the same time. Hence, variations in the price of the stocks that have to do with market risk are not going to offset each other. They're going to happen at the same time across the board in your portfolio. Now, the point then is that it doesn't matter how many stocks you have in your portfolio. There is a part of the variations in the price of the stocks, a part of it that you will not be able, a part of this risk that you will not be able to get rid of. So by putting your eggs in many different baskets, you're only going to be able to get rid of firm-specific risk. Unfortunately, the part that corresponds to variations due to market risk is a part that you will not be able to get rid of. Now, this argument, let me actually illustrate it with the following plot. Think about looking at past historical returns, past historical prices of the stocks, and think about doing the following exercise. You go ahead and you compute the standard deviation of portfolios that have more or less stocks or bonds in them. And then you go ahead and you plot in the horizontal axis the number of stocks that you have in your portfolio, and in the vertical axis, the standard deviation of each one of those portfolios. What you should expect is that when you compute the standard deviation of these historical returns associated with portfolios with different number of stocks in them, is that the behavior of that is going to display this type of pattern. The more stocks you include in your portfolio, the lower will be the standard deviation. However, it will not always decrease. It will decrease up to a certain point. It will never go below that blue line. What is happening here? Well, what is happening here is that to the extent that you include more and more stocks in your portfolio, the more you get rid of firm-specific risk. Now, when you're done doing this, by including many portfolios in your portfolio, then there's no way to go any further below, because you're going to be stuck with market risk. In this picture, market risk is indicated by that blue line. There's no way you're going to go below that. So, in the jargon of finance, firm-specific risk can be diversified away. However, market risk cannot. Now, what is the consequence? How does this translate into our trade-off between risk and return? Now, a fundamental point is that firm-specific risk does not matter when it comes to the trade-off between risk and expected return or reward. And why is that? Well, suppose an extreme situation. Suppose a situation in which all stocks had only firm-specific risk. Of course, this is a very unrealistic situation, but it will give us the intuition behind the idea that firm-specific risk does not matter. Now, if stocks have only firm-specific risk, and this risk is actually rewarded with a higher expected return, that means that the expected return of these stocks will be higher than the risk-free rate. The risk-free rate is our somehow benchmark because there's no risk with a risk-free asset. Well, if all these stocks only had firm-specific risk and this risk were to be rewarded, then what this implies is that the portfolio that you're building will have an expected return at both the risk-free rate. Now, as you include more and more assets in your portfolio, you're reducing all this firm-specific risk. If all of them only have firm-specific risk, at some point you would have eliminated all the firm-specific risk in your portfolio. But since it's only firm-specific risk that these stocks have, you would actually have eliminated all risk in your portfolio. So the situation is that you have a large portfolio of assets with no risk whatsoever and a reward that is above the risk-free rate. Now, let's see what happens then with an example. Let's make this illustration this example a little bit more illustrative. And to be a little bit more specific, suppose that the portfolio's expected return, this portfolio of stocks that has no firm-specific risk because it has been eliminated, is equal to 5%. Since we said, okay, firm-specific is going to be rewarded, we said, okay, it should be above the risk-free rate. So assume that the return of the risk-free asset is actually 3%. Now, continuing with the example, suppose that now we go ahead and we borrow 1,000 monetary units, and then we invest this money in the portfolio. So we take the 1,000, we buy units of this portfolio, we invest it in the portfolio, and then what happens? What would be our payoff? Well, since the portfolio is going to have a return of 5%, an expected return of 5%, with no risk whatsoever, that means that for sure we'll have that at the end of the period, the amount of money that we own is equal to 1,050. Now, we have to return the loan, which means that by the end of the period, we have a negative payoff of 1,030. Now, what happened? Well, we earn 30 monetary units. And the important thing is that we're going to earn them for sure, no matter what happens, because we had no risk in our portfolio. Now, this is a dream come true. Note that you could borrow 1 million monetary units, and then the profit, the riskless profit of this operation will actually be 30,000. Or you can do it like 100 million. Now, the point is that this would be an arbitrage opportunity. This will be equivalent to making money out of nothing. And of course, we know that this is not possible. So, the only consequence of this example, the important point of this example is that firm-specific risk does not matter. Firm-specific risk will not be rewarded, should not be rewarded with a higher expected return. And therefore, it is only systematic risk that matters. So, what then should be the proper trade-off between risk and return? What can we say more specific about this trade-off? What we can say is that the higher the systematic risk, the higher expected return. So now we can make sense of our picture. Now, what happens here is that those large portfolios, those red circles, corresponded to investments that had no firm-specific risk. They contained many financial assets, and therefore, the firm-specific risk was removed from them. for these large portfolios, it happened that the standard deviation was a proper measure of risk because they only had systematic risk, and then this measure was actually capturing systematic risk. Now, what happened though with the return of individual stocks? What happened was that they include this return includes firm-specific risk also. And therefore, if we are to use a standard deviation to measure risk, we're making a mistake when it comes to individual stocks, because that standard deviation is going to include a component that corresponds to firm-specific risk. And therefore, if we did that, this is not going to accommodate the intuition that we have just derived. It should be, remember, the higher systematic risk, the higher expected return. Now, only a question remains. How then can we go ahead and measure systematic risk? We know that we could potentially use the standard deviation when we deal with large portfolios. What do we do when we deal with individual stocks or individual financial assets? How do we find a proper measure of risk for them? And this is a question that we're going to leave unanswered here, but we will get back to it later. Thanks for your attention.